My name is Warren MacKenzie, and I am a stewardship counselor with a company called Highview Financial. We are a company that finds active managers or puts together investment portfolios using both active managers and exchange-traded funds. We don't manage money ourselves because we want to avoid the conflict of interest that exists when you're passing judgment on your own stock picking and performance. So my article today is what I call the scientific method versus the emotional method of making investment decisions. Well, this article came about because I had an interview with an individual who came to me, and he wanted some advice on a portfolio of exchange-traded funds. So I explained the exchange-traded funds, some information that he wanted to know. Then I went on to explain to him why I felt that this was a wealthy individual, more than $10 million. And I felt that he would do better if he was to have a portfolio of sort of best-in-category managers in 7 or 8 different investment mandates. So I explained all that, and ultimately he said no thanks, but no thanks, and he went on and he went with somebody who would provide him with exchange-traded funds that he was looking for. And so that got me to thinking, you know, why do people sort of refuse to look at the facts, you know, sometimes? And it got me thinking about sort of the difference between what you might call a scientific method and an emotional method. And in a scientific method, if you have a theory, you would test the theory by saying that if this theory works, then these things cannot happen. And for example, if you were using the scientific method to test an investment theory, you might say, okay, I believe exchange-traded funds are better, but if I find a portfolio that over 10 years has outperformed lower risk and slightly higher return after all fees, then okay, maybe I'm wrong. Maybe exchange-traded funds are not always the best situation. The emotional method might be just, okay, I know that exchange-traded funds are the best, and I'm not going to look at anything or listen to anything that contradicts what I made up my mind about. Now, in this case, the individual had made up his mind really based on 2 things. There was an article in the New York Times that analyzed the performance of quite a large number of investment managers. I'm not sure how many, but let's say well over 100. And those managers that had all beaten the benchmark in the first year, and then the reporter checked to see their performance after 5 years, and maybe half of them had not consistently beaten the benchmark. And then after 10 years, none of those original managers had consistently beaten the benchmark. Now, this individual interpreted that to mean that none of them had done better on average than the benchmark, but that's not actually what the article said. Because if you took a manager that had, for example, say the Canadian equity manager or more out in Calgary, who has over the last 15 years beaten the benchmark by, I'm just guessing, maybe 2% per annum on average, but there might have been 1 year out of 10 that he underperformed. So according to this article, this writer in the New York Times, he would have said, well, he hasn't consistently beaten the benchmark because there was 1 year out of 10 that he didn't, and yet the average return was, let's say, 2% higher. So that was one of his the things that made him focus on ETFs. And the other was some comments by Warren Buffett. And Warren Buffett is on record as saying that when he passes away, he would like his wife just to have a portfolio of ETFs. And and he's also said that, generally people would be better off using exchange traded funds. Now, I agree with that in most cases. If the choice is an individual advisor who's going to try to buy stocks and bonds, Canadian and international, all kinds of stocks and bonds, then I think the investor would be better off with a portfolio of exchange traded funds. But, Warren Buffett is, I think, he's being critical of things like high fee mutual funds and individual stock picking. But I believe that if Warren Buffett had the choice of some place where he could follow a disciplined investment program with proper performance reporting, best in category managers, that he would say that, and if the evidence is that these managers have over a 10-year period outperformed with lower risk, lower volatility, then I think he would say that that's better. And of course, Warren Buffett himself does not use exchange traded funds. He's an active investor. So that was what made me think about the sort of the scientific method versus the emotional method. This individual just didn't want to hear any facts that contradicted, what he had made up his mind. And I think maybe that's, you get to a point that you're just tired of the decision making. You just want to get it over with. And I think there's also an element where maybe you just don't believe somebody that's contradicting what you set out to do. But in this particular case, this individual is going to do as well as the exchange traded funds, but I know that these managers that that I've identified have in the past 10 years, they have outperformed after fees by about 1% per annum. So it's a pretty significant loss if one can't open their eyes and sort of just examine the facts and maybe say, well, based on these facts, like, why did this happen? And that's that was the genesis of this particular article.